Hello everyone and welcome to another video. In this episode of 2 Minute Finance, I'm going to be explaining what bonds are. In its simplest form, a bond is a loan. The most common issuers of bonds, also known as the borrowers, are governments and companies. Governments borrow money for a number of reasons. It could be to finance day-to-day expenses such as road maintenance, or it could be to fund a war. Companies will use borrowed money to grow their business, for example, to fund some research and development for a new product. The borrower will often pay interest on a bond so that the lender has a return on their investment and makes it worthwhile. This is known as a bond coupon. Most bonds will have a fixed coupon rate of say 3%, which will mean if $1,000 is borrowed, $1,030 will be paid back in total. Bonds also have what is known as a maturity date. This is a predetermined date on which the initial loan amount must be paid back in full to the lender. Typically, bonds will have a maturity date of at least 5 years from the issue date, and sometimes up to 50. In order to determine how safe it is to invest in a bond, credit rating companies have been set up to evaluate the likeliness that the issuer will default. Standard & Poor's run a scale which ranges from AAA to D. The top-notch investment-grade bonds will typically be issued by governments and blue-chip companies that have an incredibly strong balance sheet. An example of a sub-investment grade bond may be from a small company in an emerging market. As always, however, the lower the grade of the bond, the higher the interest payment should be. This is because the more risk you take on, the greater the return on investment should be. Bonds can be traded on the secondary market, however in some cases they may not be readily accessible to retail investors, in which case you may want to look at bond ETFs instead. The main influencer on bond prices in the secondary market is the underlying interbank interest rate that is set by the government. This is because, if this rate moves, the bond price will change in order to keep its fixed coupon rate of return competitive. Bonds should become a significant part of your portfolio in later life, as they are deemed to be lower risk than equities. They also produce a reliable income, which could be withdrawn and used to cover living expenses. Thank you for watching this video. Please like and subscribe, and any questions you have drop in the comments section below.